Hello, and welcome back. When people start planning for retirement, they often think about Social Security and taxes as two separate things. They create a plan for claiming their benefits, and then they have a separate idea of what their taxes might look like. But in reality, these two pieces of the retirement puzzle are directly connected. How much you pay in taxes can be heavily influenced by your Social Security. Today we're going to talk about how to make these two pieces fit together perfectly, so you can keep more of your hard-earned money. The first thing you must know is your Social Security benefits might be taxable. It all comes down to a special calculation the IRS uses called provisional income. Think of it as a formula. It's the sum of three things: half of your Social Security, plus wages or pension or IRA withdrawals, and last, any tax-exempt interest you may have earned. That total is your provisional income, and it's the number that determines if you owe taxes on your benefits. Once you have that number, you compare it to the IRS thresholds. For a married couple filing jointly, if your provisional income is under $32,000, your Social Security is free. If it's between $32,000 and $44,000, up to 50% of your benefits may become taxable. And if you're over $44,000, up to the 85% of your benefits could be subject to income tax. These thresholds are surprisingly low and haven't been adjusted for inflation, which means more and more retirees find themselves paying taxes on their Social Security every year. So what can you do about it? The most important step is to plan your income streams strategically. You have control over when and where you pull money from. For example, if you know a withdrawal from your traditional IRA will push you over a threshold and make your Social Security taxable, could you pull the needed income from a different source? Maybe you take money from a Roth IRA, since Roth distributions don't count towards your provisional income. Or maybe use cash from a savings account. It's all about coordinating your withdrawals to keep that provisional income number as low as possible. Don't ignore the impact of other income. The biggest mistake we see is people taking a large, unplanned withdrawal from a 401k or IRA without thinking about the domino effect. That one withdrawal can not only be taxed itself, but it can also cause a ripple effect that could make your Social Security benefits taxable and even increase your Medicare premiums. Don't wait too long to create a tax-efficient withdrawal plan. While some advisors suggest waiting for a golden window after you retire, we believe planning should start years earlier. The sooner you plan, the more control you have and the more options available to you. As you can see, making the Social Security tax piece fit requires looking at your entire retirement puzzle. It's not just about one number, it's about how your income, investments, and tax strategies all work together to create a single, clear picture for your retirement. It can feel like a lot to manage on your own. We built our online resource center to give you the guides and tools you need to learn more about each of these pieces. And if you have a specific question about your retirement, we invite you to schedule a free, no obligation, 15-minute call with me personally. Thanks for watching and have a great day.